traders, and welcome to yet another episode. And in this episode, we are going to discuss about smart money concept. So, what is smart money concept? Basically, what is called SMC. And with this one, I'm going to explain with examples so that you can be able to understand or relate with it. So, when we talk about smart money concept refers to what we call institutional trading logic. So we want to reason how institutions reason when they are trading. So they focus, maybe for instance, institutions, they do focus on liquidity, order flow, such kind of things. So, but you find for retail traders, they think differently, and the reason why most of the retail traders lose. So the purpose of the SMC is to fine tune us or to bring us to a point whereby you can be able to reason the same way as the institutional traders. So it focuses on how banks and large players move the market. So the moment you understand how these banks or large players move the market, then we as retail traders, we are able to align ourselves and trade like the banks or trade like the large players because these are the ones that really move the market. So SMC also helps retail traders align with the market makers. Okay, so it will help you as a retail trader to align with the market maker. So the core principle behind the SMC is liquidity. So institutions need liquidity basically to enter large positions, and you find that the price often moves to grab liquidity before reversing, and stop ants are a very common tactic when it comes to smart money concept. So the first thing that you need to understand in the smart money concept is the market structure. So the market structure, this is whereby you want to identify when we have an uptrend market, when we have a downtrend market, or maybe probably an instance where the market is reversing from uptrend to downtrend or from downtrend to uptrend. So when we have series of higher highs and higher lows, that is an uptrend. And when we have series of lower lows and lower highs, that's a downtrend. So smart money concept uses structure to identify these particular entry points. So for reversals, we are looking at the change of character or what we call the shift in market structure. And for a trending market, we want to look at the break of structure or basically what we call BOS or BMS, break of market structure. So this is an example of a change in character with a BOS. So as you can see, this is a downtrend market. This diagram that I drew here, this is a downtrend market. So when the market takes these liquidity levels here and breaks below it, we say that a BOS has taken place. And you can see several BOSs. But it reaches a point when the market breaks above the previous high of this downtrend, right? And then once that happens, we say that now we have a reversal from a downtrend to uptrend. And here, what we have here is a change in market, a change in character. And therefore, now we start having BOS in an uptrend market where the market is creating or taking out the previous liquidity levels or the previous highs, pushing up, then retracing like that. Okay, so we also have another example of a shift in market structure. So a shift in market structure, the difference between a shift in market structure and a change in character is that for a change in character, we want to see this price push below this particular low. And then once it does that, then it pushes up above and high. But in this case, what we have is that the market pushes, trades within this liquidity or trades within this internal range. Okay, so this is the internal range. So we have this as the major low, and we have, sorry, so let me delete that and mark it well. So we have this as the major low, and also we have this point as the major high. So the market is trading as the market pushed down, it didn't break this major low, and then when it pushes up, it breaks above this major high, and therefore now we have a shift in market structure, which is an indication of a reversal, a reversing market from a downtrend to an uptrend. Then we have what we call the order blocks. So these are some of the concept in smart money concepts. So order blocks, these are basically the last bullish candle before a major move on the downside. That gives us a bearish order block, and the last bearish candle before the price pushes up, that gives us a bullish order block. So I have done a video basically explaining how to identify high probability order blocks. You can just go to the description. I have the link to the video attached, and you are able to know how to identify the order blocks. So these order blocks act as a zone or zones where institution enters trades. So there are key characteristics of a high probability order blocks, because not all order blocks are high probability. So the first characteristics we want to say that shift in market structure or a change in character, or maybe in a trending market, we want to see a BOS. And then we mark the last either buy candle for a bullish, for a bearish order block, or the last sell candle for bearish, for a bullish order block, right? So we are marking the last bullish candle for a bearish order block, and the last bearish candle for a bullish order block. So they are key entries. So we wait for the price to retrace back to the zone where we have marked the order block, and then now we can be able to take a trade. Right. So this shows a very nice example. As you can see, this is a market that is pushing on the downside. So here we have a BOS, or a break in structure. Then we mark the last buy candle before this push on the downside, and then we wait for the price to come back to this particular level. Remember what we said in the previous video, that the time and price is very important when it comes to these concept, smart money concept. So we want to take trades when the market is coming to this zone, the order block. For this case, the bearish order block. We want it to be in a specific time period, either within the Asian kill zone, the London kill zone, the New York kill zone, or the London close kill zone. So as you can see, this one, the price came here during the New York kill zone, and we see now price dropping swiftly and targeting these liquidity levels that we're talking about. So remember, we talked about anytime the price, the concept of liquidity, when the market takes out liquidity, we anticipate some bit of retracement. So you can see the market pushed down here, took out liquidity, and then it retraced. So it came again here, took out these liquidities here, right? So these lows here, these are what you're calling liquidity, sell side liquidity, and then retraces. Comes again, takes out the liquidities at this particular point, okay, there, and then we see the market retracing. So it's a very key concept that you need to align with it anytime that you're trading the smart money concept, and you can use these liquidity levels basically for your targets. So the other concept that is very common with smart money concept is what we call the fair value gaps. And these are gaps in prices we are not trading or card, or maybe probably where you see the market maybe daily opening with a candle with a gap. Sometimes you also find the price the weekly opening up with a gap. But the gaps we are talking here is that when you are comparing at least 3 candles, and this is how we are able to identify our fair value gaps. So it's comprised of 3 candles. So for instance, we see the first candle like that. Then the next candle opens up, all right, opens up there and pushes on the downside. And then we see the other candle also probably opening up and pushing on the downside, okay? So what we have here now, this is the first candle, the second candle, and the third candlestick. So we use the low of the first candle and the high of the third candle, and we mark that as our fair value gap. So this is the FVG. So we want the price to revisit this level again, and then now from this level, we'll be looking for selling opportunities. So how do you look at a high probability fair value gap? The first thing that you want to look at is this fair value gap should be at least near an order block. So this might be a high probability order block, or probably you might see this fair value gap. You want to trade those fair value gaps. If you are looking at the bearish fair value gap, therefore you are looking at a gap that is within the premium level. Okay, so you need to take a Fibonacci mark from the highest to the lowest, and then you want to trade those fair value gaps that are within the premium levels, that is the bearish fair value gap. For bullish fair value gap, you want to look at them from the discount level. So with these also fair value gaps, you can be able to trade the inverted IFVG, inverted fair value gap, but I'll be doing another video basically to be able to explain about the inverted fair value gaps. So and here is a very good example of a fair value gap. As you can see at this particular point, this is the first candle, right? That is the first candle. Then we have this second candle, and then we have this third candle. So we take the week of the third candle and the week of the second candle of the first candle, and this is where we get our fair value gap. So we want to wait for the price to come to that point, and then now we take a sell. So if you look at from the high of that first candle to the low of the third candle, then this is a premium level whereby it's very high probability for you to be able to take trades. Also for the fair value gap, it's important as well to align them with the kill zones. So high probability fair value gaps will definitely be mitigated during either the London kill zone, the New York kill zone, the London close kill zone, or maybe probably the Asian kill zone. So so that's quite effective, or that's quite insightful. So the key thing is to be able to be in a position whereby you can back test, so that at least the concept can be in your fingertips. Then we have liquidity pools, and liquidity pools, these are clusters of stop losses that is above highs or below lows, where institutional use these as targets. So as you're trading, you can be able to look at where we have maybe the buy side liquidities or the sell side liquidities. So the highs gives us the buy side liquidities, the lows give us the sell side liquidities, and these we are looking at maybe the lows of a particular trading session or the highs of a particular trading session. We are looking also at the lows or the highs of the day. We are looking at the lows and the highs of the week, etc., etc. So price will often spike into these areas before reversing, or maybe probably retracing. So as you can see, if you're taking this trade from this fair value gap, we will be targeting here. We have these two lows gives us equal lows, and we see the price dropping all the way to this particular level, takes out the liquidities at that particular point, and then now before we start seeing a push on the upper direction. Of course, even at this particular point, if you look keenly, you'll find that the price was able to take out the liquidities at that particular point with this candle, and then we have a reversal back again to the fair value gap, and then now we see the price retrace. So these intermediate lows, you can use them basically in terms of taking your partials and then and trailing your profits as you look at maybe probably taking your overall TP at these particular levels at the equal lows. Okay, so the good thing with the ICT concept or the smart money concept is that they will give you a high risk to reward ratio, right, which is very effective, especially for you as a trader. So a very simple example of an entry, I did one using the Euro USD. So you identify the change in character and you mark the order block, you wait for the price, you wait for liquidity sweep above the previous highs, then you enter on retest of order block or fair value gap. Okay, so as you can see, this is quite a very simple example. So here we have some highs resting at this particular point. So you wait for the price to, first of all, this is where you begin. You look at the change in character. So then you mark the last OB at that particular point. And then once you mark the OB, remember this is a bearish order block. So we are looking at the last buy candle before the price pushing on the downside. And this is our last buy candle. So we mark that as our bearish order block. Then as the price is coming to this particular point, then we want to see this is what we call inducement, right? Price taking out these intermediate highs. So, and then the price taps the order block, and then now we get our very good sell, which will give you at least a risk to reward ratio of 1:2. And remember, when you're taking these sells, don't forget that it should be within the kill zone when the price is coming back to this OB. So the time here should be within the kill zone, either the Asian kill zone, the New York kill zone, the London kill zone, or the London close kill zone. More about the kill zone, I have done a very nice video elaborating these kill zones, and you'll check the link in my bio, in the bio or in the description of this video, so that you can be able to refresh about, or you can be able to understand about the kill zones, which is very important. We call it price and time theory. So again, risk management is very important even in SMC, as much as it's giving you a risk to reward ratio of a higher risk to reward ratio. So always use your stop loss below or above OBs. So this is an OB. You can see where I'm putting my stop loss above the OB. Okay, so then always ensure that you have a risk to reward ratio of 1 to 2% per trade. So don't risk more than 2% of your capital per trade. And if you're taking several trades at a time, let's say maybe 4 trades at a time, so ensure that the cumulative risk of the 4 trades that or the 4 positions that are running should not exceed 2%. So be selective with trades. Only look for quality over quantity. So this is where you're going to look for A+ setup, and these are setup that meet A+ setup is a setup that meets all your trading conditions, all right? All your trading conditions as described in your trading plan. So it's quality over quantity. So it's always important. And when you go for quality, you realize that sometimes you can get 2 to 3 setup per week, sometimes even 4 setup. And there can be also some weeks whereby you don't get any setup. So you don't need to panic. The key thing is you better not trade than to trade and lose your money. So the pros and cons of smart money concept. Advantages is that it aligns with institutional logic. Remember, when you're trading, you want to trade like the banks. It gives you a high risk to reward ratio setup, and it has a strong edge, especially if you're able to practice it with time. So the disadvantage of this is that it has a steep learning curve. Found most of the traders taking quite some time to be able to understand SMC, but the moment you understand SMC, then it becomes a game changer. If you don't understand SMC, again, I'm not emphasizing that you stick with SMC. Remember, each and every person is able differently. So maybe you can try another strategy that you feel is easier for you to understand. So then it requires a backtesting and discipline, not only SMC, but each and every strategy that you're going to use. It will require a lot of backtesting so that you can be able to prove the probability of the strategy, and also it will require discipline, irrespective of whether you're using SMC or any other strategy. So as I wind up, remember SMC gives insight into how the market really moves, and therefore, as we always say, that the trend is your friend. So the moment you're able to understand SMC, because it begins by understanding the basic market structure, then it will help you to be able to trade in accordance with the trend. So the key thing is to practice, to journal, and refine your hedge. So don't forget to journal those trades, even if you are backtesting it or even if you're trading in your demonstration account, make sure that you journal. Even your live trade, make sure that you journal, because the purpose of the journal is that it will help you identify your mistakes or your weak points, and you're able to improve on the weak points. And also it will help you identify your strong points or your strong areas, and you can be able to capitalize on those strong areas, basically to give you an edge. So with that, thank you so much. I believe you got some value. Make sure to like, subscribe, and share these even with your fellow traders, so that they can also be able to benefit. So until next time, keep watch, as the next episode is coming soon.